Welcome to Value Research Interview. These are interviews where we try and delve into the minds of people who manage your money. And today we have Harish Krishnan, and he is responsible for keeping an eye on your money at Birla Sun Life Asset Management Company, the equity money.
That's right.
So welcome, Harish, to be with us and share your perspective in terms of how you are navigating or beginning to navigate at Birla Sun Life. But before that, from coding at Infosys to managing funds, what happened? Just you did your MBA and it landed, or was it a thoughtful decision to be getting into money management?
No, it was completely serendipity, right? So I was very fortunate during my MBA that I was taught by practitioners. There were these gentlemen who had come, Manish Chokani, I taught, and then you had Professor Rajesh Tiwari from UTI, Institute of Capital Markets, who came and taught us. And I was fascinated by, at that point of time, of course, a lot went over my head, but there were two questions that they taught me, which I still think, drives my overall thinking and shapes my overall worldview, which is that that entire course, there was only one question that he wanted answered. He said that you are all in your 20s now, okay? Imagine that you get placed in the choices of institutions that you crave for. At 40, you make your pot of money, and then you realize that enough is enough. You want to take a break and go to Himalayas for sannyas for 20 years. What is the one name that you would buy, which you will buy when you are at 40 and you will encash it when you are at 60? And now it seemed a very simple assignment at that point of time, but early on I was introduced to this concept of the survivability of a company as the most important yardstick. That the terminal value comprises only
Going
if
to
the
Himalaya
company,
is important.
Yes.
Okay.
So if there is as much as you can get caught on by the fad, etc., the fact that the company needs to survive for 20 years is the most important thing. The second thing that he brought on was something, because I had always this craving for consulting, okay, from a MBA, right? And so he had a very interesting way in which he would conduct his classes. He would say that, imagine that, you had the company management for 30 minutes, okay, and you have to ask them only 5 questions, okay. What those 5 questions will be, the answers to which will make you determine whether you have to go or not go with this company for the next 20 years. Now, again, the point that that really imprinted on me was that, this is something by which you have access to the top management, okay? But more importantly, there are questions that you need to ask which are not the current obsession, but something which is going to remain the obsession for the next 20 years. And therefore, you need to think like an owner, like a business manager, not necessarily like an investor who's wanting to. And so these two things really had an impact. Of course, I still wanted to get placed in consulting and FMCG and marketing. And while I did get placed in quite a few of these, one of the opportunities that came up was with Kotak. And I thought, at that point of time, it was with Kotak Securities. People in my family still didn't know what securities meant. They thought ki MBA pad ke security guard ki company mein kyun jaa raha hai?
Okay.
But, and then once I got in, I realized that this is as simple as consulting. The only thing is there's a skin in the game. Unlike a consulting where you just have to give advice and move on, here you're putting your own money to work with it. And that thus began my tryst with investing.
It will be very different from consulting. I imagine, consulting is so much of pretension.
Now I am come to realize that more and more over time. Yes, but the ability to zoom in and zoom out, okay, the ability to make decisions, because see, ultimately as minority investors, we will never be able to decide with 100% of information. You will have to pull the trigger at 65-70% of information. 50-55% you will get it from public records and Google Zindabad and all that, right? But from 55 to 65, it is your diligence, those 5 questions that you ask. From 65 to 75, I think it is a behavioral aspect as to what you will do when faced with various times when the trade doesn't work for you. That determines, and then once you are convinced of it, you need to pull it. So it's not that way very different, but yes, I think the key difference is the skin in the game. Here you're putting your money to work where your mouth is. It is just not about writing a report and signing off.
So after being at Kotak for 2 decades and now moving to Birla Sun Life. What are the things that you're bringing about, and what are the things that you have left behind?
No, Kotak was and still is my family. I've spent most of my time in that wonderful place. My broader thinking is as follows: that equity markets and equity culture in India and equity mutual funds, if you were to think about it, over the course of my career, we've scaled up from 1 lakh crores to about 25, 26 lakh crores, right? Now, if you think about during this entire journey, okay, we've acted with a responsibility. We are, after all, custodians of third-party money, fiduciary responsibility. But if you think of from the process of investing, very little has changed over the course of the last 20, 25 years as we have moved from 1 lakh to 25 lakh crores. Yes, investing is timeless. You don't necessarily have to reinvent the wheel just because the scale is different. But there are certain aspects which we think need to meaningfully improve as we look at the opportunity from 25 to 50 and 50 to 100 lakh crores, which is where I think that the canvas really opens up. Which is in terms of investment process, the amount of data that we are starting to see through alternate forms of data. I mean, investing was primarily only about reading the annual report, but now you're getting a whole range of data points that are coming through, which can help your overall decision making. More importantly, investing is as much an art as in science, no doubt about it. But the way in which we measure investment outcomes, it's like, say, a sport. You don't measure the skill of a player by the number of century he or she scores, but there are a whole range of other metrics and measures that you can do from an input decision making variable. The amount of technology that is going to come in and is embracing us in so many different forms with an investment,
with AI and chat GPT,
that of course is one element, but even with the basic brass tacks as to what to look for, how you are going to define your problem statement, how are you going to break down your entire investment thesis into sub-segments, and you start measuring the efficacy of each of your decision making. Because ultimately, like sports, investment is a probabilistic endeavor. Okay, if you get more hits than misses, you are home. And therefore, how do you measure that? It can't be only on the basis of an outcome. It has to be basis on the basis of input. So those are the ways
dissecting the drivers.
Those are the ways in which you try and build a repeatable aspect of investing. See, I've always believed that investment stands on 3 dimensions. The first dimension is that of an insight, which in the case of active managers, you've got the active insight that, which is where you want to go against the grain of the crowd. You want to basically have a variant perception, right? The second is, of course, the aspect of cost and the overall value that we are bringing in for the cost that we charge. But the third and the more ignored aspect is that of repeatability, which is the process repeatable for you to keep executing at scale, so that you can keep taking over the challenges over that. And that is where I think that frontier of investment management, I would think that over the course of the next 10-15 years will be very different from what it is today. And which is where I thought I would take this plunge of trying to shape that here at Aditya Birla Sun Life. Which is wanting to make those changes and wanting to kind of reinvest.
You see that willingness.
Absolutely. To reorient, because there is a leapfrogging that we have to do, to try and go to where the marketplace will go to rather than being where it is today. Right, and so that really is where we are bringing in as far as Aditya Birla.
I'll get on to the Aditya Birla range of funds and that is being managed there and the kind of orientation. But coming to the much broader markets and economy, the Sensex has crossed nice round number 80,000, and the kind of flows that we have seen, it looks unreal. We haven't seen it in a long time. Is it really sustainable, backed by earnings and flows?
Sure. So I think markets are an interplay of 3 variables. You've got earnings, you've got liquidity, and you've got sentiment, and how they interplay with each other determines the medium-term outlook. So when I think about earnings, and if you look at, say, broad numbers, pre-COVID, the total profit pool of India, listed India Inc., was close to about 6 lakh crores. That has moved to close to about 14 lakh crores, right? We think that that has happened through primarily because you had these loss pools which were very large, which got converted into profits. You also saw basically commodities getting reflated thanks to the US stimulus that happened, which led to a huge reflation in global commodities, which helped to clean up the balance sheets of corporate India. And lastly, of course, the unorganized to organized, which we've seen from demonetization levels,
Steady shift.
the shift and got accelerated during COVID times, right? So now when we think about the next doubling of likely earnings, we think it's more likely to happen over the course of the next 6-7 years rather than the 3-4 years that we've kind of seen over the course of the last 3-4 years, right? Now, what gives us confidence that it is going to double in the next 6-7 years? The earnings I'm talking about. See, by and large, the profits of tomorrow are driven by the investments of today. And therefore, it's important to track the capex investments that listed India Inc. is doing. Today, we are in a zone wherein that 6 lakh crores of profits has become 14 lakh crores of profits. OCF have also gone to close to about 13.5 lakh crores. But the capex levels from 6 lakh crores has moved to 9 lakh crores. So we think that this 9 lakh crores is likely to move to 10, 11, 12 lakh crores. So today, we are in a zone wherein we have a problem of plenty. Which is essentially that the cash flows that the companies are throwing in, they still don't have the confidence or the animal spirits yet to deploy that in large, meaningful
They don't
scale.
have confidence or they don't have the avenues?
I think it's a bit of both. I mean, sometimes what happens is all it needs is one small catalyst for it to snowball, right? I mean, I'll give you the classic example of what we've seen in, say, the US. For example, the big tech, you saw a success of, say, ChatGPT, OpenAI, okay? And that got riled on by Microsoft acquiring it. And you saw the market cap creation. The moment companies realize that market loves it, you have seen all the 7-10 companies spending like there's no tomorrow, right? So these are things that change.
That has led to another thing called NVIDIA.
So the reality is, certain things, why you have to go by how cycles form. You will never be able to predict with any accuracy, but you have to go by the past cyclical behavior, which is that, when market starts appreciating certain things, companies will follow it. And therefore, you're going to see
just not investors chase recent past performance. Even companies, chase recent successes.
I mean, the only point that we need to be worried of is in good times is where bad decisions get taken. In bad times, generally only good decisions get taken because you're already facing so much adversity. You're cleaning up. So you typically move on to do things which dramatically actually improve. Today, we are in good times. Yet we are not yet in times wherein companies are going astray in terms of investing left, right, and center. When we get there is when we need to start getting really worried about where markets are. Having said that, yes, if I were to look at, say, the delta in terms of, how much has been contributed by earnings and how much has been contributed by, say, valuation increase. So we did this exercise about pre-COVID till now. For the large caps, the top 100, by and large, the entire market cap is explained by the earnings. In fact, it's got derated a bit. Okay, but if I look at, say, for mid caps, roughly about 67% of the market cap increase is coming from earnings, and about 33% coming in from valuation re-rating.
They have been fancied.
But when you think about small caps, that number is 50-50. And when you think about micro caps, that number is 33% from earnings and 67% coming from valuation multiples expanding meaningfully. And therefore, lower down the curve is where I would think that there is some disconnect coming through. Because see, I am of the belief that while India has got a lot of good companies, a lot of competent managements, the reality is we have our own share of black sheep. We have our own share of not so well run, not the greatest of corporate governance companies. And therefore, when you see all and sundry do so well, it generally is a precursor of not a great investing experience. So to kind of summarize, I would say that it's not a bubble. It's not that
large caps. If they are nicely in place, then that is 85% of the market.
Correct. So I think it's just that one shouldn't get into the habit of FOMO. And believing in price action that every 3 months you have to get a reasonable amount of returns and move into FNO, etc. This is the time wherein it would be better to dial down risk rather than to increase risk.
Market has made a big leap post-elections. What's your take on the resilience short term and medium term?
To be quite honest, it's taken me by surprise because there was a lot riding on the election. Pre-election also there was a big rally and a positioning of the market participants in terms of the verdict that they were expecting, and therefore the verdict was not exactly what we. Of course, the fact that there has been continuity of the key ministerial positions, the fact that they have a majority, of course, and in a relative world wherein we are seeing huge anti-incumbency in the rest of the world.
All over the world,
right? So it still is a relative world in that sense. So I guess that explains a lot of this kind of reaction. Even after the disappointment in terms of the market perception of where the odds were and how it eventually turned out. I think that the climb back has been quite honest, very, very surprising to me as well. I would think that in the
what
budget,
can puncture it?
I think it's the set of expectations that go way beyond is where I think we are more likely to shoot ourselves in the foot. It is not so much, we don't really think there is a huge amount of misallocation of capital as far as corporate India is concerned. Like I said, animal spirits have just started coming through. So we have not reached that kind of a zone wherein we can say that people are making mistakes both on the ground as well as the perception of investors is also going for a complete toss. So here it is only about investors possibly overextending some of the positives that they've seen in the last 2-3 years and extrapolating that. I think that therefore a consolidation and a time correction, all of these phrases we can think of, is what kind of
might happen.
It's what kind of gets us back into zone before the next big move. And in that sense, corporate results, for example, this quarter doesn't appear to be the best of corporate results that we are getting into. We are talking of reasonably low. More importantly, the cash flow conversion of corporate India has kind of waned off compared to the very healthy cash levels that they were otherwise generating. So I think at the end of the day, profit numbers are one statement or an accounting statement. The reality is market actually give a lot more weightage to cash flows in the long term, and that clearly has seen some kind of a pullback. So I would say that I can't really put a pulse or a reason as to why it'll. Once it happens, maybe we can give you a million reasons to try and justify it.
Hindsight is always perfect. Yeah,
correct. But at this point of time, we do think that it makes sense to dial back risk rather than to go into the frontier of risk in the hope that you want to constantly make the next multi-bagger. It will be a lot more prudent to dial down.
As you said that post 2020, the COVID and the turnaround and the earnings momentum and the kind of the reason why earnings really leaped and investors came in hordes and they have benefited. Now many investors have come in, many individual investors coming to the market in the last 2-3 years with huge expectation. What should be a realistic expectation?
See, by and large, when we think about, I'm just taken by an analogy that I read somewhere. If, let's say, a drone were to be circling above us and it captures the dog collar, okay, and just the drone is seeing the footage of the dog collar, you will think that markets are going anywhere or the dog is moving anywhere on its own. But the reality is that the dog is basically following what the dog owner is doing it and the leash that it's providing it, right? In a very similar sense is that market movements in the near term are random. But in the medium term to the long term, it will be governed by earnings. And therefore, if you believe that earnings are going to double likely in the next 6-7 years, to believe that markets will have a different view than the impending earnings, I think is possibly being a bit too naive. We cannot constantly be bulling in returns from the future. It will at some point come to bite us off. And therefore, it is only realistic to go into asset allocation. Of course, there is a lot of wealth to be made in India. We're not being defensive at all. It's just that, temper down expectations, focus on good companies. Like I said, risk has got disproportionately rewarded. So we did this analysis, in NSE 500, right? Out of 500 companies, 60% of companies in the last 12 months have given a 10% alpha compared to NSE 500. Okay, and we plotted this over a region of the last 25 years. This is one of the highest readings that we've seen on a 12-month time frame. So to believe that you can constantly keep finding these winners,
keep giving this premium
for
and still make money.
I really don't think so that's justified. So I think as they say in Kung Fu Panda, the real magic or the real power comes from within. In the same sense, I think it is more the reining in of the greed, and to have a realistic sense is what will
no,
give.
But that actually, if you look at it on a relative basis in the same marketplace, we have plenty of loss-making money in the private equity private markets, which are priced differently.
Yes.
So this may not be looking all that bad.
Yes.
When you have the the Paytms and the Nikas coming over.
Yeah. So see, at the end of the day, I think my hypothesis is that given the fact that listed India Inc. is actually throwing so much of money, okay, I wouldn't be surprised if a lot of these privately funded companies actually reside in a lot of conglomerates going forward. So it's the natural habitat. Rather than looking at a listing as an eventual outcome, I would think there will be a lot more M&A that can happen through.
Many of these companies will go and reside there.
Possible. I mean, if you think of the very definition of a conglomerate, in the good old days, I mean, before all this unicorn and startup and all that came through, if you think of a DuPont or all of these, conglomerates globally, they would seed different technologies, different units within their own company. They would say that I'm not going to monitor you for profits, etc. I'm going to incubate you. That is essentially what the startup world is, right? So ideally, it needs to be incubated over there.
Now it's happening independently.
Independently, of course, it is good that it is happening independently.
Somewhere,
somewhere you're finding the capital that can nourish it for a reasonable amount of time. But now they may find their way into a lot of these conglomerates as well. Given the fact that they're throwing so much of cash with not so much avenues to deploy.
Or if they become, questionable things, then they eventually find a habitat in one of the established groups. Look at Satya.
That's right. And more importantly, one of the key negatives when we look at a lot of these startups is that, the cap table, there is no skin in the game. I mean, because it's entirely made of private equity and all that. The moment it goes into a conglomerate, you get that skin in the game and the entire cap table completely changes, right?
Or the orientation
changes. So therefore, there is multiple pluses. Now, of course, when it happens, we'll have to see.
How much of a concern is that, a lot of people, many of these large companies that have come up, they have never made profit. They have existed for 20 years and nobody has any skin in the business. And nobody, apparently looks like nobody cares. And because, you are always able to find a bigger fool without making the money.
True.
So how long can it last? Or, how attracted are you to this game?
No, so there are these studies by BIS, the Bank of International Settlements, which actually looks at what is called the zombie firms globally, right? And since 2007, I mean, the very nature of capitalism is that that destruction is inevitable. I mean, the inefficient firms have to die. And so therefore capital can get redeployed into the more profitable, more firms that can create value into the future, right? What they have seen is that post GFC, because of various policies that have happened in the Western world more specifically, we have seen an influx of these zombie firms which have gone up significantly. The fact that interest rates were so low, there were these pools of money which could constantly keep, and they are seeing populations which are on the decline, which meant that they were throwing in more and more dollars than consuming it, led to a lot of these zombie firms. India's manifestation is also reasonably similar. The good thing in India is, of course,
that money has come from there
from there, right? But the good thing in India is that our demography is actually quite good. So while at a particular scale it might not make sense, but eventually once it becomes a habit, I think there is a lot of sense in a lot of these unicorns or a lot of startup world. So I won't be dismissive of them, But then you need to get the basic unit economics in place. Otherwise,
Without that,
otherwise, it becomes very difficult, because if you keep expanding for the sake of expansion, okay, without any ROE or cash flows coming through, it is like cancer. I mean, growth for the sake of growth is very dangerous. Growth, if it comes in with ROE, then it can create
it's entirely
value.
a function of flow only then.
Yeah, but
what can sustain it otherwise?
Yes, but the point is that if you are going to be dependent of external sources of capital, at some point, as they say, sometimes you are the pigeon, sometimes you are the statue, right? The things the shoe can shuffle very quickly, and you may realize that if you are used to a particular steroid of liquidity, when somebody in New York blinks, you may not necessarily get that same source of capital, and then how do you sustain your business and your employees becomes very key. So anyway, that's a very philosophical discussion.
Now getting to very specific question which will be of interest to my audience, which is many of the Aditya Birla Sun Life equity funds have struggled in recent past and for a very long time, and in a very cyclical way. So what is your agenda? What have you made? What changes have you made, and what are you going to make?
Sure. So
change in the thinking process.
True. See, essentially, if you were to think of any equity mutual fund house, we have multiple schemes, multiple mandates, multiple styles, every fund house, right? And multiple stocks. But just like you have an 80-20 principle, which applies to most aspects of life, within investment also there is an 80-20 rule, right? For the Indian equity mutual fund houses, the top 75 positions account for 80% of AUM. So while you may have 300, 400, 450 names as a fund house, in any fund house you look at it, the top 75 roughly account for 80% of AUM. Now, what is in this top 75 positions, therefore, is the key to determining the sustainability of performance that comes through as a fund house, right? Now, broadly, there are two broad areas where money goes in from the top 75. The first are in names which are part of Nifty. And I'm using Nifty because it's a very popular, most tracked benchmark. Everybody looks at it, right? So there's a lot of money which is residing there. And then there are names which are part of any fund house's top 75, but which are outside of Nifty. Okay. So if I were to give an analogy, think of, say, batting. Okay. Now, the reality is, if you're a batsman, as a kid, you want to hit every ball for a six. But in a test match, if you were to think of it, there are different kinds of batsmen. You've got the opening batsman, you've got the middle order, and then you've got the tail, right? The job of the opening batsman is to defend, is to break down the opposition and yet give a reasonable rate so that it can be carried on by the middle order and the tail, right? You don't want to give them too much of an ask, and therefore you are always getting at least some purchase from the market, right? The job of the middle order is to score the maximum number of runs, but more importantly in test match, to score or to face the maximum number of balls and to have the maximum partnership, right? And then the tail is to up the strike rate, right? Now, if I were to look at the same analogy from a investment thing, okay, I would say that the positions in Nifty are more like your opening batsmen. They are very much needed.
The big ones.
The big ones, okay. But it's not to say that you can't make alpha out of them. But given the fact that every fund house has got positions out there, the edge or the extent of differential alpha that can come from these names is limited. I mean, we can create, but it can't be very long lasting, right? Or repeatable from that side.
But in Nifty, if you actually choose 40 of the Nifty, or just 30 of them, you emphasize that. How much of an alpha potential does that have?
Yes, sir.
Because one is by selection, the other is by
the weightage,
deselection. Yeah?
Right. So I think there is
not choosing one.
That's right. So there is reasonable amount of alpha that can come through.
Okay.
But the point really is that we are in a relative world, right? And therefore the extent of alpha that comes outside of Nifty is a lot higher than what you can get into Nifty. Ultimately, capital is fungible. There is no real reason for it to be only in these names. Of course, we have scheme mandates. I'm not saying that we can't. We can overrule that. But broadly, as a fund house, this is where it is, right? So essentially, like I said, the Nifty positions are like your opening batsman. Okay, the non-Nifty but which are part of top 75 are your middle order. Okay, and then you've got the tail. Now, if I were to look at how we have changed as a fund house from 2013 to 2022-23, right? We had a great run from 2013 to 2018-19 as Birla Equity Fund House, right? At that point of time, broadly, our positions in Nifty used to be between 35 to 40%. Our positions in the middle order, which is what is part of the top 75, but not in Nifty, okay, used to be around 40, 45, 50%. And then you had a tail of about 10, 15%, right? Now, over the course of time, our exposure into Nifty names moved from say 40% to as high as 56, 58, 59%. So we've gone more and more into Nifty positions, right? We then went more and more into the tail. So we are taking...
You tended to be in almost an index fund.
To a certain extent, I mean, not necessarily.
More
I mean, we had high
index.
active share, etc. But a lot of our capital got more and more into Nifty names, right? We moved a lot of our money into the tail positions as well, in the sense that our core middle order, which used to be as much as say 40, 45, 50%, came down to about 21, 22%. Okay. So now when you want sustainable, repeatable outcomes as a process, you need to have capital in each of these three sleeves, and each of them have a particular ask. More importantly, middle order is the one that has to face a maximum number of balls, which means that it has to be allocated the maximum number of capital that really comes into it, right? So our endeavor, therefore, is to move this over time to get into a zone wherein we have equal in each of these three. So what we are talking about is basically taking bigger, bolder bets. The number of positions...
Bigger, bolder bets. Okay.
Yes. Because, see, ultimately, we have to bat off the front foot. It is not about being defensive, or it's not being about wearing a risk hat, etc. The end is that we have an opportunity cost of capital, and we have to deliver, right? Now, there are some nuances as to how you want to take a 25-30 crore position and how you want to take, say, a 1,000 crore position, right? The one of the nuance which is there is that you can buy a 30, 40, 50 crore position when the stock is in momentum. Okay, you will get it. But you can never buy a 1,000 crore position when the stock is in momentum. Because the moment you put in your 100 crores, the stock is already moving. It's like adding fuel to the fire, right? So the reality is that when you're building a bigger sized position as a fund house, you need to be counter-cyclical.
Worry about the impact.
You have to be counter-cyclical. So you have to buy the first 500, 600 crores on the way down rather than wanting to participate on the way up. Now, to bring in this counter-cyclicality, we need to have a framework, right? Because the biggest worry is that we shouldn't buy into a value trap with an even larger proportion of our capital.
That was the case, where it turned out to be 5-year waiting, and for some others it was 1 year.
So how do you therefore identify that? So the way we have is basically we have 9 questions that we want answered for every investment name. But I would focus on 2 key questions because those are the linchpin decision-making variables, right? The first question that we focus on is that can we reimagine this company to double between 3 to 6 years? We have to think from an absolute return point of view rather than from a relative return point of view. And therefore, there is an expectation of a cost of capital. This doesn't mean that, we are projecting for the next 10 years a DCF and then we are trying to get that. But at any given point of time, if there are, say, 50 variables that impact a company, there are 2-3 variables that actually matter. So what those 2-3 variables are and what is your variant perception on those 2-3 variables determines the extent of mispricing and whether you're able to capitalize on. So that's the first question. The second question is even more important to me, okay, which is in case I get the thesis wrong, which it's quite likely that I get it wrong, it's probability after all. At what price do I buy in so that I get the principal out in 3 years time frame without any loss? So that brings in the margin of safety aspect, right? Now the idea,
the worst case scenario.
In some sense, of course, these are still scenarios. I mean, can things be even worse than what it is? Of course. But the reality is once you have this kind of a process mapped in, you then start looking at prices in which you want to deploy capital rather than react to what the stock market is telling you every day, right? So which means that good prices and good news don't come together. Okay, so you need to know beforehand that which are the good companies and what is the price point where you want to deploy your 500, 700, 800 crores, right? Because when that price comes in, it is going to come in not because God has been kind, but something has gone wrong in that company in the near term, right? It could be maybe the past 2 quarters are bad. There is a large seller which has come on through. The promoter is selling in, which is completely unexpected. But at that point of time, if you chicken out, and say that you're going to wait under 2-3 quarters, then you have missed the bus, right? And that is where we're kind of putting it to work. So this is as far as the buying is concerned. But I would say that the real big change or the real big insight that we have is that as fund managers, I jokingly say we are all Abhimanyus. We have all got these nice buying frameworks as to when to buy, etc. Where we really struggle as human beings is when to sell and how to sell. Because selling always comes in with emotions, a regret of selling too early or too late. And therefore, you take a very suboptimal decision. So we've got now a very clear selling process, which is that in case a stock underperforms by 20% against NSE 500 total returns, it comes onto a separate dashboard, right? If it underperforms or outperforms, both ways it comes to that, right? Now, if it underperforms, because that is what the typical worry point generally is, when it outperforms, of course, we are happy more often than not. We do the following series of steps, okay? The first step is we don't want to increase our position before we have met the company or revalidated our thesis. So that typically is a buying freeze that typically comes through. Secondly, we do an internal meeting, try and gauge what the issue is. In case it's a sectoral issue, maybe a regulatory event that has happened, that is fine. We are not really worried about those instances. But if there's a particular company which is getting singled out, then we are more worried about the lasting impact that it can have.
A sector thing.
Right. The third thing that we do is we seek out a meeting with our management, okay? In that meeting, we typically want 2 new members who have not met the management in the past to come and meet them so that they get a different view or a different line of thinking over that. Now, post the meeting, when we come back, we have to do one of 3 things. First, double up, okay? Which is that you like the company before, it has fallen down, your thesis seems in your view, in the view of the investment committee, reasonably good. You go and embrace that opportunity like it's not tomorrow, and you show greater conviction, right? Second, you quit. Instead of living in hope that something will change, you move out of that capital without worrying about the fact that it's a call that went wrong. So be it. As long as you are moving it into things where you have conviction and you have greater control over things, rather than living in hope that it is going to perform. The third thing is we have a sunset point, which is sometimes when we meet companies, they say, this particular plant which was to come through, maybe it's got delayed by under 3 months. Sometimes it could be excuses, sometimes it could be reality. So in which case, we think that, okay, it makes sense to give them a 6-month window or whatever be it, to wait for that event to come through. And at that point of time, we take that decision. So through this entire process, over the course of the last 6-7 months, broadly, if you were to look at our portfolios, we've done about 55,000 crores worth of change, okay? About 25,000 crores one way we have bought, and about 27,000 crores one way we've sold, okay? Now, within these 25,000 crores of buying, the top 75, which is the focus that I spoke about, account for about 20,000 crores. And there are a whole range of names that we publish in our fact sheet. Just to give you a sense as to some of the names, again, these are all part of the fact sheet, so there is nothing incremental that we are talking about. So names like, say, Whirlpool. We had a 325 crore. It came with a loss because of the fact that the promoter wanted to sell out. It came down to 200 crores. We cut the single largest check in our history. We put in 700 crores at 1,277. Today, that position, which was at 200 crores, is a 1,500 crore position. It's our largest non-Nifty bet at this point of time. Similarly, Zomato, Shriram Finance, you've got Voltas, you've got, say, D-Mart, you've got Godrej Consumer, you've got SRF. A lot of them are counter-cyclical bets. Good companies, but may not have out of favor in the last, say, 1-2 years, and which is where we are trying to move towards. More importantly, what we have sold is, I think, something far more important for you to look at, and which is where when you look at those names, I'm not wanting to spell them out, but you will get a sense of as to see this thing, to see how this is starting to work through.
Listening to your answer, we launched our magazine Mutual Fund Insight many years back, October 2002. And Bharat Shah, who was the CIO of
ABSL,
BSL, Birla Sun Life then. And his quote, which was in that headline, in that interview was, "We bought well, we never sold well." So maybe, after it has taken 20 years to really articulate when to sell and not be a Abhimanyu.
Yes.
Your first step to being do a factor-based investing, you've recently launched this ABSL Quant Fund. Do you really believe that rule-driven strategies will be able to help you anticipate some sector positions or some bets or some things than the great people like you?
No, so I think there is a role for human managed fund products, and there's a role for rule based products, right? In my opinion, man plus machine is better than man or machine. Okay. So as much there are insights of human beings that can be built into the machines, and there are aspects of the machine that can be used as far as. So when I talk about when we think about machines and why they quant or rule based products make sense, it is not in terms of what they are selecting, but what they are avoiding that makes money, right? So it's again the selling thing, which is actually the key strength of the quant based or a rule based product, right? And which is what we've suffered. I'm saying as an industry, and also at Aditya Birla Sun Life historically, and that's a bias of human fund managers, right? And so if you can use that same insight, which is the process that I spoke about, of the learnings of quant into thing, you can actually use it. Similarly, if you were to think about a pure rule based or a pure machine driven product, what really is the weakness of the machine driven product is that it has no real diligence. Okay, as much as we think that there are some great companies in India, there are as many number of badly run companies which are there for the quick return and not really carrying out for shareholders. If we were really going only by machine, a lot of these names come through. So the strength of the human being is it doesn't really want to partner with bad companies because of our reputation and credibility on the line, etc. We generally want to avoid bad companies. So therefore, there is an insight that we can build from the human fund managers and then give it to the machine rather than purely relying on machine. So I think if we are able to intelligently do this on common sense principles, it is not really rocket science that we have to do some PhD level thesis out here. But there is factor investing. It is it's a discipline that has worked across the world. Okay, India, we're just getting started. But instead of running it purely as pure machines, if we are able to embrace the insight of the human fund manager and its insights
as well,
then you have a far better experience of repeatability that can come through. Having said that, I think pure rule based, which is your question, I think will only be a niche. We cannot be managing more than say 10-15% of overall AUM as an industry in various rule based products. There is a place for it. We cannot overthink and over deploy capital on those rule based products.
Now looking at your range of product, we were very intrigued by this Flexi-Cap fund and business cycle fund. There was 60% overlap. How should investors choose, and why you should have this much of overlap? Why have another product?
Sure. No, I think the role of a business cycle fund is to have a lot more sectoral skew. Okay. While the starting universe is the same for both of them. Okay. The reality is that the active share of say the business cycle typically tends to be a lot more higher than that of Flexi-Cap. And therefore it is like you can go from journey point A to B trying to in a bus, or you can do it in a Formula 1 car, trying to cut through each of the corners as fastly as you can. So the business cycle, I would say, is a far more aggressively managed, higher active share product within the same universe with a lot more sectoral skew compared to what you would think that the Flexi-Cap is. So by nature, there is going to be some amount of overlap, but the active share will tend to be much higher when it comes to the business cycle compared to that of the Flexi-Cap.
Now you are in this role as a CIO for the first time, and not very long around. So how do you oversee and supervise other equity fund managers to ensure a cohesive investment strategy? All the things that you have mentioned before.
Sure.
Are these rule-based things implemented for them to follow, or there is a sitting with them across the table all through the day and driving it?
No, so I think, see, it's a bit of both. In the sense that, one can't be rigid to say that, it is my way or the highway. The reality is that every fund manager has got their style. They've also thought through about the framework in terms of their investment decisions, right? And therefore, you can never put a gun across the head and say that, you have to get in or get out. That's a recipe for disaster, in my opinion. On the same way, there are certain learnings and certain processes that we are trying to bring in place so that the overall team benefits, and and as much as the overall team benefits, in my own funds I stand to benefit the most with that thing. So it is in my own selfish interest that we have a very well functioning research team. That we are trying to have a very sharp and focused viewpoint on each of the stocks that we own. That we are very clear as to why we are owning these points, right? And more importantly, we have a process of selling.
Is there a case that one fund decides to sell, but the other fund doesn't think that it's worth a sell today?
Yes, absolutely,
Okay,
and
it's possible.
Yes, of course. See, the idea is, the idea of having multiple fund managers is that, right? Otherwise, you might as well have just one person running the show. The reality is that, like I said, there are different mandates. There are different, reasons why something is there. It's a part of a puzzle in some sense, right? Each portfolio is that, and what each stock brings in is in the eyes of their creator, which is the fund manager, solves a different need than what you may think about it. So we are completely open about these discussions. So if I were to think about it, every fund in ABSL has broadly 3 sleeves. Okay, the first sleeve is the benchmark sleeve. Which is your top heavy names, etc.
How much percentage can go there? Depends on the
fund construct. So if it's a large
in a Flexi-Cap fund.
So in a Flexi-Cap, I would say about 25-30% would go here, right? Maybe slightly lower than that. Then you've got the absolute return focus, the counter-cyclical core, which is primarily wanting to play for the long term, wherein you're talking about hoping to double your money or double each investment over the course of the next 3, 4, 5, 6 years, right? And that is the fulcrum of the entire fund. And then you've got a relative suite. Wherein you're looking at primarily, what your view on the market is. Do you have to add risk, reduce risk, which sector is you want to add on, which IPO looks interesting, etc.
These are tactical.
These are tactical, right? Now, if you think about it, that there is enough freedom that we are giving out here. For anybody to express. There is reasonable freedom even we are giving out here. It's just that it has to be slightly more consultative. There's a lot more buy-in from research, and there is a lot of contribution that each fund manager and each investment professional in our team is bringing in. It's not only the fund managers, the researchers equally. In fact, they are the heart of this decision making. And then you've got the risk management oversight of the benchmark. So this brings in a way in which you get the risk overlay. You bring in the long-termness and the counter-cyclicality of the fund house, and you give the freedom for the fund managers to drive the way they see fit in terms of the corners that they are navigating in the way they see fit, right? So by and large, broadly, if you were to think about it, you've got roughly about, I would say, 50 to 75% in the first 2 sleeves, which is benchmark as well as in terms of the counter-cyclicality. And then you've got between 20 to 40% on the mandate, etc., and the style of the fund manager in terms of the relative thing. And that is how, I would like to believe that, we've given independence, and yet we have an overarching philosophy in terms of where we want to bind ourselves.
Binding. Thank you very much, Harish, for being here, sharing your perspective, and wish you very best in all that you have started so far.
Thank you so much. I need all the luck and your support. Thank you.